All right, so let's begin the show. And today, first up in the show is our very favorite segment called as Meet Your Fund Manager. And in this segment, we have a fund in concern, a category in concern, where we decode the further going trajectory of this particular category and whether it's right for the investors to participate right now. Today, the category in focus will be a small cap category, and the fund that we'll be talking about is PGIM India Small Cap Fund. I'm joined by Utsav Mehta, Fund Manager, PGIM India Mutual Fund, and Hemant, Wiseinvest. Good evening and welcome to the show, both of you. And Hemant, first question to you, because before we lay the foundation and try and talk about the fund in concern, I really want to understand the kind of trajectory and movement this particular category has shown in last 3 years, and also if you want to compare it with last 6 months. Good amount of a phase where we saw good amount of return and a small blip in last 6 months due to market volatility that's been trickling on the small cap as well.
Absolutely right. I mean, if you see the last 6 months, the small caps performance obviously we've seen the volatility, we've seen the returns that have gone down as compared to the returns that was being offered by this category in the period of 3 years prior to this 6-month period. But I think we all know that equity market by nature is volatile, and whenever there are bouts of volatilities, there are some concerns. The different segments of the market behave differently, and I think that's what exactly has happened. That's why we are talking about maybe valuations looking slightly better in large cap as compared to mid and small. But I think all three segments have an important role to play in every investor's portfolio, especially for those investors who are investing for the long term and who are investing in a disciplined manner. The key, of course, is how much allocation we have to different segments. So yes, there has been volatility. But I think given the fact that the way we are expecting the economy to bounce back, maybe going forward, and we will still remain maybe the fastest growing economy in the world. So I think there are going to be opportunities in different sectors and segments. And we know that there are some emerging sectors that are they are only in the companies that are there only from the mid cap and the small cap, like digital, and look at electronic manufacturing. There are a number of sectors. So I think each segment is important. The key is to keep focus on your time horizon, continue the discipline process, and not worry too much about the current volatility in this segment.
All right. Let's take a fund manager's view also. And Utsav, talking about the category, the volatility that we've been seeing since last 6 months. Coming up times, how do you want to help our viewers understand the further going trajectory? Volatility can be seen. Should we be expecting the similar kind of return that we saw in the past, where there was a one-sided run-up? Looking at the quarter result, I think it will be difficult to promise those kind of returns. I mean, anyways, a fund manager can't be talking about returns, but then still, time to moderate our expectations.
Hi, good evening, Kavita and viewers. I think you've got it spot on. I think the kind of returns that you've seen over the last 3 years was a combination of India as an economy recovering really well from the lows of COVID, reporting very sharp profit growth numbers, combined with what has been unprecedented flows domestic into the market that has led to the kind of returns that they were. But if you see the last 5-year returns, and if you were sitting in 2019, the kind of environment that existed in terms of the kind of growth and the kind of valuations that were available there, that same kind of construct is not available today. Valuations are definitively on the higher end of what we would like to pay. And growth, obviously, from the extreme highs that we've seen over the last 2 years is now moderating. So in that context, I would like to say that sort of extrapolating past returns would be dangerous. That said, we are seeing tremendous amount of opportunities. I mean, at the end of the day, India is a growth economy. Small caps as a category offer you entry into what could be future large sectors. What we have, or what we see as potentially high return categories, is specifically more on the higher quality side. So in the last 2 or 3 years, we've seen that more high growth and higher quality companies have relatively underperformed the more value side or the poorer quality side of the market. And that, I think, over the last 6 months, as profit numbers have been normalizing, seems to be reversing quite meaningfully, and we expect that trend to continue. So, what we would probably be thinking of is to be on the more quality and growth side of the market rather than the more cyclical end of things.
All right, so now let's also talk about the kind of strategy you have laid out for PGM Small Cap Fund. What are the sectors that you are bullish on, and the sectors where you have actually, you've tampered down your exposure, and you're planning to move out of those sectors? What kind of growth story are you betting on as far as your fund is concerned?
Right. So, on the kind of sectors, look, especially for a small cap fund manager, it's hard for me to really talk about sectors as a whole, right? We're always betting on sub-segments and themes within these sectors. So it may so happen that that at some point of time we may be overweight, at least on headline basis in a particular sector, but realistically we're playing a theme within that, let's say electronic manufacturing or something on those lines. So we have certain high growth themes that are playing out in India, which are still at a very nascent stage, and we're sort of very bullish on those. One example that I can give you is something which is domestic healthcare. Domestic healthcare as a whole, sort of spending in India post-COVID has increased quite meaningfully. We're seeing a sharp change in behavior in terms of people taking out insurance, not willing to compromise on the amount that they spend on their healthcare, stepping more into hospitals for even basic level of ailments. And as a result, the entire sector is benefiting, and this is the kind of tailwind that will persist for maybe another 10 to 15 years at the very least. And those are the kind of bets that we're taking. Similarly, on consumption, as discretionary income is increasing, an average Indian whose basic needs are met, they're increasingly looking at financial savings as one avenue and discretionary spending as a second avenue. And so there are pockets within consumption. So even though overall consumption is slowing down, we are seeing certain high growth segments within consumption where incremental spending continues to increase quite meaningfully. And we've taken large positions on that side. In terms of where we are cutting down, we try not to churn our portfolio too much. We tend to take a 3 to 4 year view on our companies so as to limit our churn. It is something that maybe in the frenzied market of the last 2 to 3 years, it's not served us too well because quality as a category is not done too well. But we think going ahead it will. We have a very limited exposure to cyclical sectors, whether it be on the material side or whether it be on the utility side.
All right. So, looking at the current allocation of this fund, Hemant, what is your analysis? The fund actually has been underperforming, but it consists of some high quality names in the portfolio and definitely high growth companies. So, if we have to just maybe go back and look at the performance and compare it with the underperformance now, would you still recommend investors to hold on to this particular small cap fund?
Right, Kavita. I think the important factor is that we just talked about that small cap as a segment is a risky, though it is potentially the best segment in the stock market. So obviously the strategy has to be very stock specific. So any fund that focuses on high growth and high quality company is definitely worth considering. And the good thing about this fund is that the fund does focus on both these aspects. I think in terms of underperformance, if you see in the last couple of quarters, the performance has started improving. There were a couple of issues. Obviously, one, I think, as we just talked about, the fact that there was a phase where, the fund with the lower, capability or the potential of the growth were actually doing better than high quality, stocks in the market. And that was one of the reasons. And the second was, I think there was some issue with the sector allocation. And obviously the fund managers were, overweight on financials and consumer discretionary and underweight on utility and industrial. Obviously, the performance of these sectors didn't pan out the way it was being envisaged by the fund manager. But I think the portfolio rebalancing has been done. So my belief is that looking at the fact that the fund is focusing on high growth and high quality companies, and some kind of portfolio rebalancing has happened. So investors who are there with them definitely can give the fund some more time to see how the performance pans out and then take a decision.
All right. But then what happens is when you compare, see Hemant, now the way you decide to stick on to a fund is obviously by comparing it with the benchmark and comparing it with the peers. You think there are better pedigree funds available in the same category where one can move to, or because of the rebalancing and we've seen a relatively better performance now, there is still scope for an investor to continue their investments even through an SIP to stick to this, or there are better exposure funds in small cap category where one can shift with better names?
As you rightly mentioned, look, it all depends on how you're investing in a fund. First thing, if you're invested in lump sum, maybe you'll see the impact much more in case there are periods where the fund did not perform very well. But if you have been investing through SIP, then what happens is when the fund performance starts improving, you benefit from the fact that you invested in the phase when the fund was not performing as well. So I think if anyone who has been investing through SIP, maybe the impact in terms of performance may not be that much. Second is, again, you need to kind of look at the performance in the relative term in terms of also look at the quality of the portfolio. There will always be fund in any category which have done well. So as long as you as an investor are getting return which you think is above average, I think one can consider remaining in the fund.
Utsav, now considering the sector rebalancing, and the kind of benefit it's expected to reap as per your explanation, I also want to understand the way you are trying to mitigate the risk in this particular sector. You mentioned about your sector-specific allocation and exposure, but then going ahead, what is going to be your growth and price balance philosophy or strategy in this particular fund?
Right. So, Kavita, I think you've sort of mentioned this earlier, but stylistically, we've always been growth managers. And I think in a country like India, realistically, you're essentially paying for growth. What we tend to focus on is more sustainable growth, which means we don't want to really chase something that will look good for 6 months and then suddenly the growth disappears. We're typically focused on 2 to 3 year growth at the very least. A more sustainable proxy India play. Yes, there are phases like we've seen in the last 2-3 years when there has been a frenzied one-way rally where micro bubbles were formed, where that kind of style doesn't sometimes always pay off. But realistically, we've always been true to our style. We continue to be true to our style. And to answer your question in a nutshell, where we lie on that price and growth spectrum, we are more growth oriented. We think that as the pool of companies that report double-digit growth on profits continues to narrow as we wean off a cyclical rally, that consistent 15 to 20% profit growth number will continue to get a premium vis-a-vis others. And that's what we're sticking to. For us, at the end of the day, the market cap over a longer period of time always chases profit numbers, and that's what we're focused on.
All right, I think that will be all as far as this particular fund is concerned and this category is concerned. Thank you so much, Utsav, for being on the show and helping our viewers understand PGIM India Small Cap Fund and their strategy ahead in this particular category.
If you like this video, then like, share and subscribe to ET Now.